The new Secure Act is about to be signed into law. It offers 14 major changes to retirement tax laws, benefiting both employers and employees, including the self-employed. Most of the provisions in this new law start in different tax years. This new law increases the age for required minimum distributions from 72 to 73 in 2023, and then increases it further to 75 in 2033. Starting in 2024, all catch-up contributions to IRAs, which is $1,000 for people at least age 50, will be indexed to inflation. Starting in 2025, the catch-up contribution limits for taxpayers aged 60 to 63 increases from $7,500 per year to at least $11,250. The new rule says that the limits would increase to the greater of $10,000, or 50% more than the regular catch-up amount that year. But since the catch-up amount already equals $7,500, 50% more will be at least $11,250, and with the inflation adjustment in 2024, it will probably be even more. Taxpayers earning more than $145,000 must put the catch-up money in a Roth 401k, so high-income taxpayers will have to pay taxes on their catch-up contribution. Lower-income taxpayers may choose a pre-tax or after-tax contribution. Starting in 2024, student loan payments will count as retirement contributions for the purposes of qualifying for a matching contribution in a qualified retirement plan. You may also receive a one-time penalty-free withdrawal from your 401k or your IRA for an emergency, which is defined as an unforeseeable or immediate financial need for either you or your family. Money left over in a 529 college savings account may be moved to a Roth IRA. This new rule will alleviate a major concern for many parents who fret about having to pay income taxes and a penalty on 529 funds if they no longer need it for higher educational expenses, such as if a child decides not to go to college. However, there is a $35,000 lifetime limit on these transfers per account beneficiary and other restrictions to lower the benefit for affluent taxpayers. There are no required minimum distributions from Roth IRAs because contributions are made with after-tax dollars, but RMDs did apply to 401k Roth accounts. Even though contributions were with after-tax dollars, the required minimum distribution for Roth accounts was the same as for regular 401k accounts. Now, Roth accounts are treated the same as Roth IRAs regarding RMDs. Low to middle income taxpayers may claim the Retirement Savings Contribution Credit, sometimes known as the Saver's Credit, when they make eligible contributions to certain tax-advantaged retirement plans. The credit may be up to $1,000 for a contribution of $2,000. Although, because the credit is non-refundable, the maximum amount was limited by ordinary income tax liability. This new rule, which only applies to tax years starting in 2027, eliminates the limit imposed by tax liability, but as with the Saver's Credit, it has income limits. The new law helps small businesses with the cost of offering a retirement plan by providing tax credits that would offset some of the cost. It would also expand access to multiple employer plans, allowing small employers in the nonprofit sector to act as a group in setting up a group plan to get more favorable investment options at a lower cost. Employers could allow employees to make one withdrawal up to $1,000 annually from their 401k or IRA for certain emergency expenses without owing the 10% additional penalty for non-qualified distributions. Employees can choose to repay the amount within 3 years, but if they choose not to, then they cannot make another emergency withdrawal for 3 years. Starting in 2024, student loan payments would count as retirement contributions for the purposes of qualifying for a matching contribution in a workplace retirement plan. The new law requires employers starting new retirement plans after 2024 to automatically enroll workers into 401k and 403b plans once they become eligible, while also allowing them to opt out if they so choose. The initial contribution rate must be at least 3%, but not more than 10%. Contributions must increase by 1 percentage point each year until reaching at least 10%, but not more than 15%. Plans created before 2025 do not have to follow these new rules. There are exemptions for small businesses with no more than 10 workers, new businesses operating for less than 3 years, and church and government plans. Employers with a 401k plan must allow longer-term part-time employees to participate, including those with 1 year of service of at least 1,000 hours, or 2 consecutive years with 500 hours of service each year. Employers will be permitted to automatically enroll workers into emergency savings accounts linked to employees' retirement accounts. Contributions can be up to 3% of their salary, up to a maximum of $2,500. These emergency savings accounts are like Roth accounts. Contributions are taxed, but withdrawals are tax-free. This option may help to minimize the need for hardship withdrawals, which create a tax liability and tax penalties. It may also reduce the need for 401k loans, which avoids taxes and penalties, but may incur an opportunity cost by not being invested. And if the employee quits or is terminated, then the employer may require the loan to be repaid quickly.
Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.